Yeah, the main discrepancy is that gold is not exactly an inflation hedge. It's a hedge against
I see.
negative real yields.
Okay.
And so even if you look back in the 70s, the two big spikes that gold had were really during the two periods of time, the mid 70s and then the very end of that period, where negative real yields got down to negative 4%. So mostly it's a replacement for things like treasuries and other low risk assets. And so if you look at treasuries, for example, there were decades in time where they were great investments because they paid you a yield that was notably higher than the inflation rate. And so, for example, if inflation is 3% and the treasury is 6%, which it was in many prior decades, you could buy that treasury and earn in a compound a positive real return and grow your wealth.
Yields are starting to tick up, especially on the long end. So do you see a correlation there? Is that because of higher inflation expectations?
Yeah, they've been tracking inflation expectations pretty closely. And so that's actually one of the things that held gold down is that even though inflation is starting to tick up a little bit, and especially inflation expectations, which look forward a little bit, the bond yields on the long end of the curve have been ticking up as well. And so the real yield of the 10-year Treasury has kind of hovered around negative 1% rather than continuing to go down because that nominal yield's keeping up with it. And so if this were to continue, that actually presents, in addition to, not being good for bondholders because, even though it's better for people buying into bonds now, it's bad for existing holders of bonds because a yield going up means the prices are going down. It also potentially puts some pressure on the mega cap growth stocks or even some of the smaller growth stocks because a lot of them are based on the premise of very, very low discount rates to justify their high valuations. And so if you get that continued upward yield pressure, that can potentially put a lot of downward valuation pressure on some of those really high growth stocks that are in many cases trading at 30, 40, or 50 times earnings.
What about gold now? You mentioned that rising yields could happen as a result of inflation expectations. Well, isn't that just ironic again? Because gold in itself is supposed to be an asset that protects you against inflation. Yet when you have higher inflation expectations, yields rise and that pushes gold down, or at least weighs it down. So how do you, as an investor, how do you, meander around this discrepancy?
Yeah, the main discrepancy is that gold is not exactly an inflation hedge. It's a hedge against negative real yields.
Okay.
And so even if you look back in the 70s, the two big spikes that gold had were really during the two periods of time, the mid 70s and then the very end of that period, where negative real yields got down to negative 4%. So I'm pretty neutral for about 6 months, and I still remain long-term bullish. And the key variable to watch is actually real yields. And so if you look at gold compared to the 10-year Treasury minus the prevailing inflation rate, and that's people can debate about what the real inflation rate is, but because gold is largely financialized, it tends to follow the 10-year Treasury minus the official CPI. Or you can use the Treasury break-even rate. So it's what the TIPS market is pricing in as their inflation expectations. And so if you track gold next to real yields, it actually aligns inversely very closely. And so those are the periods where you had that big spike in gold. And for example, if you look at the 1980s, inflation was still running pretty hot, but real yields were positive because Volcker had jacked up the interest rates. And so you could get compensated for that inflation with positive real yields. And so what gold really does is protect you from an environment where inflation is much higher than the bond yields. And that's what we've seen over in 2020 is that you saw, gold, over the past couple of years, gold had a pretty big appreciation because it was protecting against that. But now since about, late summer of 2020, negative real yields have been roughly flat. They hit a bottom of negative 1.08% on the 10-year. And that's been kind of choppy and sideways since then, which is why we've seen some consolidation in gold. I do think as you look out a couple of years, maybe in late 2021, I do think that inflation could rise faster than bond yields, especially because the Federal Reserve has some tools they can use to suppress the long end of the curve and keep that submerged below the inflation rate. And if that were to happen, that'd be very good for the precious metals and particularly gold. And so gold's actually doing what I'd expect it to do during this period when real yields are kind of chopping along sideways. And so what we saw from, during that big gold bull market from mid-2018 all the way up to mid-2020, you saw real yields collapse. And so real yields went from like positive 1% and they fell all the way down to like negative 1.08%, but based on that measure. And then from there, because the 10-year Treasury started rising, so the 10-year nominal yield started rising, roughly, a little bit faster than the official inflation rate, you actually started to get kind of a, no longer deterioration on the negative real yields part. So they went up to like, negative 0.7, which is funny because it's still negative, but it's higher than its rate of change. So it's higher than it was at negative 1.08%. And then, of course, it's tended back down again. So it's kind of been bouncing around that negative 1% area. And I think until it kind of breaks below that, it's hard to get kind of a really good move on gold and silver because, rate of change terms is not getting worse. And the only things that really held their purchasing power were dollars or short-term treasuries and things like that. So you saw stocks go down, gold go down, silver go down, copper, oil, Bitcoin, everything went down. And that's because there's a liquidity event. So you have all this kind of margin debt in the system, and basically just, positions have to unwind pretty much at any price. And then, of course, you have a lot of dollar-denominated debt held by the foreign sector. And so if that dollar begins to spike and they have trouble getting dollars to service the debt, they have to sell treasury reserves to get dollars. And of course, that makes the treasury market crash and go liquid, which is what we saw in March, and that the Federal Reserve freaked out about and literally had an emergency meeting on it and basically had to, bring out a liquidity bazooka.
Why they should buy gold, the purpose of buying gold, because as we've examined, gold actually has a very inconsistent track record of hedging against inflation, and it has a almost non-existent track record of hedging against equities volatility. That correlation is near zero.
Yeah, so mostly it's a replacement for things like treasuries and other low-risk assets. And so if you look at treasuries, for example, there were decades in time where they were great investments because they paid you a yield that was notably higher than the inflation rate. And so, for example, if inflation is 3% and the treasury is 6%, which it was in many prior decades, you could buy that treasury and earn in a compound a positive real return and grow your wealth. The problem happens is that if bond yields get so low, either due to the Federal Reserve suppressing yields or due to other factors, and let's say you have a 1% 10-year treasury, but inflation's 2% or 3%. Well, you're losing purchasing power by holding that treasury, and it's very unattractive to do so. Now, gold is a yieldless asset, and if anything, there's a slight negative yield because you're paying either security costs or transportation, shipping, all these
Storage.
kind of frictional, storage. So it's but you can basically call it a zero yielding asset. However, unlike treasuries and dollars, it's a scarce asset. And so there's about 1 ounce of gold per person in the world, estimated by the World Gold Council. And so they're not really making more of it, at least compared to the population growth. And so it kind of has that built-in inflation hedge in the sense that as broad money supply increases over time, gold does gradually appreciate. It just doesn't have these big spikes unless you have these dips in the negative real yield.
Okay.
And so it's really kind of that protection against periods of time where treasuries are failing to keep up with inflation. And so if you have a liquidity event like that, it's unlikely to have that big decoupling. So the question is what happens, days later, if you get that kind of liquidity boost, the Federal Reserve comes in, or the fiscal authority agrees to do another round of stimulus checks, whatever the case may be, and you get that pump up in assets. The question is what assets come out of that a lot stronger than other ones. So if there are companies that have become insolvent, if they have too much debt, they are likely to come out of that in a crippled state. Whereas things like gold, silver, unlevered companies, things like that, they can come out of it much stronger, which is, of course, what we saw right after March. And so, for example, if you look at what bank stocks did after March versus what silver did after March, you had a very different kind of, trajectory out of that liquidity hole. And so I wouldn't focus on specifically what happens during the liquidity crisis. It would be what happens immediately after it and then over the next, say, year or two. In addition to not being good for bondholders because even though it's better for people buying into bonds now, it's bad for existing holders of bonds. Gold compared to the 10-year treasury minus the prevailing inflation rate, and so you could get compensated for that inflation with positive real yields. It's hard to get kind of a really good move on gold and silver because rate of change terms is not getting worse. Gold is a yieldless asset, and if anything, there's a slight negative yield because you're paying either security costs or transportation, shipping, all these kind of frictional.